Hello, this is Chuck Carnevale, and I'm the Chuck in the Markets Up Chuck. Today's growth stock is Alliance Data Systems Corp., one of the most consistent growth stocks you'll ever want to see. With this blog, I'm going to take a look at the impeccable historical financial results as well as the future potential of this very exciting and fairly valued growth stock. I'm going to start out just by looking at their adjusted operating earnings per share growth going back to 2001. And as you can see, the orange line on this graph in this particular time frame represents a PE ratio of 23, which is also equal to the company's growth rate. What I really want you to see here is the consistent growth. Going through the recession of 2001, the company grew. During the Great Recession of 2008-2009, the company grew. You'll rarely see a company whose earnings growth has been as consistent and predictable as you will with Alliance Data Systems. Now let's take a look at how the price has responded to this impeccable growth. So what I've done here is I've added monthly closing stock prices. Now what's interesting is you can see how clearly the company's stock price tracked earnings over this period of time. Coming into the Great Recession, its stock price did drop, as we saw with most stocks, but because their earnings continued to grow, you saw this great surge in earnings, and now the stock looks extremely undervalued when you look at this long-term time frame here. However, I want to caution you because although this long-term record is impeccable and the growth rate has been very high, I want you to notice what happens to the growth as I shorten the time frames here. I'm going to drop this to looking at approximately the last 15 years. And the earnings growth rate is still 24%. However, I drop it to the last 10 years, and the growth rate has dropped to 16.8%. This is a $13 billion market cap company, and the point I'm making here is that even though its growth is remaining consistent, it has slowed down a little. When I drop it down to just the last 5 years, we still see it sitting at 16% approximate level. The stock was overvalued in 2013, 14, and 15, but coming into January of 2016, it has become undervalued and remains so. Now, as previously mentioned, this is a growth stock. However, the company has initiated their first dividend in 2016, which they increased dramatically to over $2 a share, which they've held. So it does pay a very small dividend. As you can see, their dividend payout ratio is very low. So that's a plus that kind of compensates a little bit from the low growth. But this is not a dividend stock per se. It has less than a 1% yield. It is still primarily a growth. Now, I would like to comment a little bit on their debt. The company has 93% debt to capital, but I want to point out that this is a credit card company and debt is their product, if you will. So it's not really heavily burdened with debt. When you look at operating cash flows, you'll get an idea of why I'm not too concerned about debt. The company has also produced prodigious amounts of operating cash flow over the years, and that cash flow, although not as consistent as earnings, has obviously been very high, and it certainly gives them the ability to amortize and handle any debt that they have outside of the product debt that they hold. The company's free cash flow has also been very high. From a valuation perspective, when you look at it in reference to another kind of a weak form of cash flow called EBITDA, you'll see that the stock price has tracked that very well. It did get overvalued, as I mentioned a couple years ago, but EBITDA is actually expected to accelerate going forward. Now, to put into perspective what all this good operating performance has translated into, had you invested $10,000 in this stock in June of 2001 and held it through yesterday's close, that $10,000 would have grown to $159,914. That's an 18.8% annualized rate of return, which is significantly better than putting the same amount in the S&P 500 or the overall stock market. So this is obviously a significantly above average company and stock. Next, I'd like to take a look at what future growth expectations are. The company is very well followed. There are over 26 analysts forecasting for 2018, 24 for this year. Now, the growth rate is expected to only average about 7% this year, but then accelerate back at 18.7% for next year, followed by 12% growth for 2019. That's a 12.6% average. Now, if this stock would trade at a normal PE of 15, which is slightly higher than the current PE, that would imply double-digit rates of return going forward, averaging somewhere between 20 and 25% a year, which is why I'm showing this stock. I think it's a very attractively valued growth stock at today's level. In conclusion, if you're looking for a high-quality, fairly valued stock that can generate double double-digit long-term total returns, you might want to take a closer look at Alliance Data Systems Corporation. This has been Chuck Carnevale saying thanks for watching.